There we go. Perfect. So the outline of today's webinar, like I mentioned before, there's going to be three different stages. So the first one is going to be preparing for retirement. This is probably one of the questions, or really one of the topics that we hear from many different age groups, just because whether you're 30 years old or whether you're 55 years old, people will often ask the question of how much do I need to be saving? So we will dive into that today and give you some sort of points to keep in mind there. The second point is going to be building the retirement paycheck. Again, a lot of people are going to be asking, hey, I've been working for 30, 40 years now. How much do I need and how am I actually going to replace that? And this is where, for me and Eric, our job becomes a bit like a puzzle for certain people. Everyone's going to have a little bit different of a unique setup. So trying to actually replace their working income is important, and it's going to be unique to them given their specific style. So finally, we're going to talk about investing in retirement. So for those who have been very diligent savers, they have been spending their money wisely. They get to retirement and now they're left wondering, how do I protect my nest egg, right? And part of what we're going to be talking about today is some characteristics that you should have in your portfolio when you get to that point.
All right, I will take over the quick intro on Klaas Financial. So I know we have a number of clients on the call, but for anybody who is new to us, we have been in business. We were founded in 1976, so we are coming up on 50 years of business next year. We have two offices, one here in Madison and one in Loves Park, Illinois. And we, as a firm, we help individuals, families, and businesses plan for retirement. So whether that's through personal financial planning that we do with individuals and families, or our retirement plan services that we offer to employers to actually help their employees save for retirement. We tend to specialize in that space. So this webinar is actually really, really exciting for us to be bringing to all of you. We work with about 1,100 households across 32 states. So I don't think it'll surprise anyone. Not everyone who lives in Wisconsin or Illinois wants to retire there. We have people who move all across the country when retirement comes. So like I said, we currently have clients in 32 states. We manage about $700 million on behalf of clients. And we are a registered investment advisor. You'll hear this term a lot, a registered investment advisor or an RIA. In that capacity, we operate as a fiduciary, meaning that we are doing our work in the best interest of our clients. And I know that sounds like it should be pretty obvious and kind of go without saying, but given the way that we are registered and the way our business is set up, it allows us to align our interests with our clients really, really well. So that's just a quick rundown on Klaas Financial.
First stage is preparing for retirement. And we actually, again, kind of broke this stage down even more into three sections with savings rate, debt elimination, and retirement goals. So starting with a savings rate, the old saying of paying yourself first doesn't really go out of style. A good rule of thumb is to save anywhere between 15 to 25% of your gross income. Now, that is, again, just sort of a rule of thumb. And even in that, I would say that's a pretty wide net. So for your specific situation, that might be a little bit different. And there are ways to calculate what your savings rate should be that are a little bit more unique to you. But 15 to 25% of your gross income is a really good baseline to use. Part of the savings rate conversation, though, is discussing how and where you're actually doing that savings. And for most people, the way that they're going to be doing that is going to be through their employer-sponsored retirement plans, 401ks, 403bs. And one of the biggest things that people can do to help themselves out is to set up automatic contributions. Not only does that help out in the sense of, hey, set it and forget it, but it also allows them to remove the temptation of dipping into their savings that hits their actual checking account. When it's in your 401k and your 403b, you have less of a temptation to do that, and there are actually also penalties to do that as well, depending on your age too. Um, in addition to that, for many people, but not all, there's also going to be employer match opportunity for you as well. Again, this is something to take advantage of, and it also ensures that you take advantage of it by giving you free contributions to your retirement account. It increases your savings without actually reducing your take-home pay. So a
Yeah,
couple
Eric, I'll
other
jump in on
points.
this one a little
Yeah,
bit here as
please.
well. With the savings rate here, we have this kind of range of 15 to 25%. Like Eric said, it's a rule of thumb, right? And it'll vary for everybody. We love to say that, but just some examples of like why might it vary, right? Let's say that perhaps you have an employer-sponsored pension plan, right? So you're going to be receiving income from that in retirement. So maybe you wouldn't necessarily need to save as high of a percentage into your 401k, 403b, whatever that plan might be. Maybe, for example, you started saving much earlier in your career and you've built up a really nice nest egg and you don't necessarily need to be maximizing the amount that you're putting in right now. And you're able to kind of balance that with some existing spending or kind of what we might call lifestyle expansion. And I think the other piece of this, as it relates to employer matches, it's like Eric said, it's free money, right? So when we meet with people, especially younger people, and they say, "How much should I be saving?" A really good spot to start is like whatever they will match in your 401k, right? So if you have to put in 6%, so your employer will match 3%, that should be where you start in terms of how much you're saving. And as that kind of mixes in with the next topic that Eric's going to talk about here, debt elimination, people will often ask us like, hey, if I have student loans, I have, mortgage, should I be paying extra on those versus saving into my retirement plan? The perfect way to approach that initially is to say, let's get the employer match on the retirement plan side, and then worry about eliminating debt beyond that. Pass it back over to you,
No,
Eric.
no, absolutely. That's a really good point. But actually, before we go to debt elimination, the last thing I want to say on the savings rate is sort of that last bullet point, which is catch-up contributions. And this applies to those who are 50 and older. It actually allows them to contribute more to 401k or a 403b than somebody who is under that. So the standard amount that you can contribute in 2025 to a 401k is 23,500. But if you're 50 and older, you can actually contribute an additional 7,500 for a total of 31,000. So if you're somebody who is a little bit behind on saving for retirement or someone who is just looking to put maybe more fuel on the fire, catch-up contributions can be a really good tool to use there.
Yeah, the other thing
Yeah,
too I'll add here
yeah,
is this just because we have to make it confusing.
yeah.
Those who are between 60 and 63, their catch-up contribution limit is actually
Mhm.
$11,250.
The
So if
super
you're
catch-up contribution.
yeah, if you are in that age group, very specific 60 to 63, you have an additional amount that you can contribute as a catch-up contribution.
Yeah, yeah. But yeah, going towards debt elimination, though, I would say the biggest thing for people to keep in mind is to, first of all, just try to avoid any unnecessary borrowing. And if you can do that, you can hopefully avoid high interest debt as well. And really what that does is it prevents you from paying significantly more over time due to just compounding interest. You often see this with credit card balances that just spiral out of control and can really strain somebody's monthly budget. Um, and when that happens, it really reduces your ability to save and invest for the future, for your retirement, or for any goals that you may have in retirement. So staying out of bad debt really helps maintain a financial stability and actually then redirects your current and future income dollars towards the future instead of really just paying for past purchases on credit. And then in the scope of retirement, it also reduces the amount that you'll eventually need from your savings to actually service debt obligations. So, Eric, any other thoughts on that before we talk about retirement goals?
No, I think, like I said, it's difficult sometimes, I think, to balance saving and paying down debt. And I think um, we might like to think that it's a very simple, well, just, save this and then make sure you're getting to the savings rate, then pay this down. But in some cases, it's a little bit less clear, and you need to actually work with an advisor to get that specific advice as it relates to your situation.
Yep. As far as retirement goals go, the biggest thing that I think we can give to people is to set as best they can, set very clear and realistic objectives. In order to do that, you need to really have a good understanding of, okay, what interests do I have? How much do I expect to maybe travel in retirement? What hobbies do I have? What is, the cost of those hobbies? So factoring in goals like that are important, but then also to consider as well is, hey, do I have a desire to leave a legacy or to support my family after I am gone as well? So all of those things really are important to figure out because in order to plan for that, you need to have an understanding of what it's actually going to look like. So clear goals will provide a focus. They're going to reduce uncertainty about what those goals are going to look like, and then they're going to guide smarter savings and investment decisions before. So
Yeah, I want to zero in on the realistic objectives here.
yeah.
I think, and we work with people obviously getting ready to retire and trying to kind of build out their expectations on how much income they're going to need, right? And I think sometimes people are maybe so eager to retire that they are, when they're trying to figure out what that monthly amount is that they need to live on, they tend to kind of start skimping and be like, well, I could get by on this, that, or the other thing. The fact of the matter is, people can retire theoretically whenever they want. It's just about the level of lifestyle you want to have, right? So if sometimes people will come to us and be really, really, they'll have a really lean budget and they say, well, if I only spend this much, then I can retire this year rather than next year or the following year. But you want to make sure you're very, very clear about what the lifestyle that you want to live in retirement looks like. And don't shortchange yourself when it comes to how much you want to be able to spend, because this is a decision you are making for the rest of your life, right? So make sure that you're realistic, or make sure that your expected spending is realistic based on the amount you've saved.
Okay. Building the retirement paycheck.
Yes, this is one of my favorite topics, mostly because I've been doing this for quite a while now, and we have very advanced software, and we have a lot of cool technology and tools that we can use with clients to show them, project out their spending and their income and their investment returns, and all these different ways we can show them likelihood of success, and we can run all of these different scenarios. And we think it's so cool and so advanced, and we get excited about it. But at the end of the day, clients will often say, that's great. I'm glad that we're in good shape. Can you show me how this is actually going to work? Like, I work right now, I get paid, whether it's every 2 weeks, once a month, whatever it might be. I get money deposited in my checking account, and that's what I use to live on. So how am I actually going to do that as I move from working to retirement, right? In many cases, they've saved money into their 401k or their IRA, whatever it might be. They have a big chunk of money, a big pile of money. What does that actually mean in terms of where I get income from? So as we look at this, there's a couple different ways to, as we say, build your retirement paycheck. But the first question we need to answer is, how much monthly income do you need to live comfortably or to live the way that you want to? So one way you can look at that is say, well, I'm just going to target a percentage of my current income and use that as my goal, my target, right? Uh, and for example, we can look here on the screen. We have, somebody with $80,000 of income before retirement, and they want to aim for a 75% replacement ratio. They would need $60,000 per year in retirement income. But what does that actually, how do you actually determine what your percentage is, right? How do you determine how much income you need? I'll tell you the way that we approach it with clients because I think it's pretty it becomes pretty straightforward. We begin with um, uh, very high spending expectations, and then we sort of work backwards. So by this I mean, if you take a look at your paycheck deposit that you get, however, whatever the frequency is that you get paid, and you say, okay, well, after I've put money into my 401k, I've paid for my health insurance, maybe put money into an HSA or an FSA. This is the amount that gets deposited to my checking account, and then I live my life based on that, right? Well, we would call that like a break-even budget, right? So whatever is getting deposited into your checking account each month for spending, we add up the total deposits and we say, well, looking at your financial situation, you don't have a bunch of credit card debt, so we know the maximum amount that you are spending is the amount that you're actually getting deposited, right? It sounds really simple, but it begins to create some boundaries for us. Okay, so let's say that someone's net pay each month, so what actually gets deposited in their bank account is, let's say easy numbers, let's say $6,000 a month gets deposited. And we kind of start there and we say, okay, well, if I wanted to replace 100% of what I'm getting right now, I would need $6,000 a month. But then, you say, well, actually, I have a mortgage that is almost paid off, and the principal and interest on that is $1,200. And once I'm done paying for the house, my mortgage is gone. Really, I'm only living on $4,800. Great. Okay. And then let's say that maybe, oh, I also, each month I will transfer $300 to my savings accounts, right? These are just simple numbers to create an example. But okay, that's also not money that you're living on, right? So we pull that back. We say, okay, maybe 4,500 really is the number that we need to live on. So it doesn't necessarily have to be a percentage, but just some process for determining exactly how much you are going to need. But more often than not, people come to us and they say, I have no idea. I don't keep a line by line budget. I'm not exactly sure. What I do know is I don't spend more than I make. And that's a really good spot for us to start and then kind of work backwards.
Yeah. No, really, 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 really good points. And I think, Eric, your point on, hey, don't get all caught up on what the percentage is going to be, especially if you're having, maybe conversations with friends and families, and they say, oh, well, I'm doing, 85%, that's what you should do too, right?
Yeah.
Understand that what your savings, um, you know, what your amount is going to be is going to be very unique to you, right? It's going to depend on a lot of factors that you have, that your friends and family might be similar, but they're not going to be in the exact same boat as you.
Yes. And please, please, please do not get bogged down in rules of thumb. We talked about a
Yeah.
rule of thumb in the last slide and targeting that 15 to 25% of your income. But so often I hear from people, they say, oh, I just read an article and it says that you need $3 million to retire, and I don't have $3 million. That is an example, but you have to look at the lifestyle that you are living relative to this person in this article that you read, because it's very likely that their financial situation is completely different from yours. Maybe you have less debt. Maybe you have lower expenses. Maybe you have a pension that they don't have, right? There are all of these factors and variables that make everybody's situation a little different. So rules of thumb are great, but don't get bogged down.
Right.
All right, let's talk about building the retirement paycheck. I love this. We start with a slide called building the retirement paycheck, and then I don't talk about it. Um, but This is where we get to I talked earlier about, having the software that shows all these really cool statistics and numbers. And at the end of the day, people just want me to write down, okay, here's how much income I need. Here's where it's coming from every month. It's getting deposited to my bank account and I'm living on it, right? When people move from working into retirement, there are a lot of changes just in your life and how you spend your time and kind of who you spend your time with. There are a lot of changes. We don't need to change the way that you receive income, right? That's one less thing we can see actually change for you. So when I say that, I mean don't change the way that you approach your cash flow. You get periodic deposits into your bank account right now. You use that to pay your bills and live your life. We want to try and continue that into retirement. So where is your income going to come from? So we're gonna look at an example here in a second, but some common retirement income sources would be, first one I think is pretty obvious, Social Security. So this will make up some portion of your retirement income. Gets deposited on a monthly basis. It's what we would call, it would fit into a guaranteed income source. An employer pension. Okay, so depending on your employer, this is becoming less and less common. Pensions are pretty expensive for employers to maintain, so many of them are going away from pensions and in lieu of that doing 401k, 403b, 457 savings plans. But a pension may be another thing that you think about as a resource for building your retirement paycheck. Your retirement accounts and your non-retirement accounts, so I'm going to group these together. Think of this just as dollars you have saved towards your retirement that you can then draw on a monthly basis, for example, to continue building the amount that you need. And then we have annuities here. This is theoretically, you could think of this as a retirement or a non-retirement account as well. The reason we've kind of separated it out here is if you have an annuity that maybe you would, what we call actually annuitize or take the dollars and turn it over to the insurance company in exchange for a monthly payment for the rest of your life. That can be another source of guaranteed income that you might use. So these are kind of all of the pieces that we have to make up your retirement paycheck. The one other one that's not on here that you might include would be like if you're doing some sort of part-time work, for example. So we don't like to think about this generally when people are retiring. We want them to actually retire. But for a lot of people, there might be, an opportunity for them to scale back their work and, maybe work half-time or maybe there's just a fun job that you want to do in retirement that provides you some income. So that could be another source of kind of building this retirement paycheck.
Just to actually add on that, Eric, a couple other sources too. And again, these are a little bit less common than the ones that are on the screen here. But if you still have maybe equity in a business and you're still receiving income that way as well, that could also be a way that you receive some retirement income, as well as through anyone that maybe owns rental real estate as well. You might be getting rental income that way. And then sort of the last one that I would mention too, and again, it's becoming more common for certain individuals just as time has moved on here, but it could be inheritance as well. Now, when it comes to inheritance, I think that the biggest thing that me and Eric probably say to a lot of our clients is, yes, it's possible that you're going to end up receiving this amount of money, but that certainly is not guaranteed, right? So when it comes to planning around inheritance, it's important to remember that you should be planning for yourself and acting as if you're going to get to retirement and be successful without that, right? Maybe as the inheritance becomes more and more likely and maybe closer, it's something that you can consider, but it's important to remember that inheritance can be part of the plan, but you have to be a little bit cautious around that as well.
Yes, I think this is where it kind of all comes together, and hopefully this will show everybody what we've been building towards here. So we have an example here, John and Jane, who have recently retired. John's 68, Jane is 67. They're now assessing how much income they'll need to withdraw from their investment portfolio to cover their retirement expenses. Their estimate came out to $10,000 a month that they would want to actually replace. And again, a lot of different ways to come to that number. But that's in this scenario, they came to the $10,000 per month. You can see the summary of investment assets that they have there on the left. So they have, a couple of IRAs, some Roth IRA dollars, and a taxable investment account, which is also what we would call a non-retirement account. And at the bottom there, you can see their guaranteed income sources. So Social Security benefits. John has a pension as well of $750 a month. So when we're building the retirement paycheck, we want to start with the guaranteed income sources. Okay, so you can see that the Social Security benefit for each of them, assuming they begin right at retirement, John's benefit is $33,000 a year, Jane's is $39,000. And then if we add in John's pension there, which he begins at retirement, that's getting us an extra $9,000 per year. So our guaranteed income source is $81,000 a year. So in this example, John and Jane are benefiting quite well from their guaranteed income sources. We are still about $39,000 short of the income goal that they want to receive. So what that means is we need to draw approximately $39,000 a year, or $3,250 a month, from their investment portfolio, which again, the list is up there at the top. And assuming that we are drawing that on a monthly basis from their investment portfolio, which is about $1.35 million, that essentially what we'd be doing is setting up a monthly withdrawal to be deposited to their checking account. And again, sort of recreating that paycheck that they were receiving while they were working. And you can see at the bottom there, we have portfolio withdrawal rate. This is the percentage of the principal balance that you are drawing out on an annual basis. Okay, so for the two of them, they have a low, what I would call a low withdrawal rate. They're at about 2.9% of 2.89% of the principal balance that they're drawing out each year. Now the reason we bring up withdrawal rate is because we're kind of coming at this from the angle of asking John and Jane, how much income do you want to have? And the $10,000 a month, in order to get there, they only need to draw about 2.89% of the dollars that they've saved. Now, that doesn't mean that that's the maximum amount, theoretically, that John and Jane could take out of the portfolio, right? This is kind of a complicated discussion as well, but you could see a withdrawal rate between 4 and 5%, for example. So it's not to say that's as much as they can take out, $3,250. That's just recreating exactly what they've asked for in retirement income. So just line up those guaranteed income sources, the John's Social Security, Jane's Social Security, John's pension, add $3,250 at the bottom from the investment portfolio. We get to the $10,000 a month that they want to live on in retirement.
Yeah. Yeah. And then just a couple other quick thoughts on that, because I think when people hear the rate that's coming out of their portfolio, often what they'll hear is the 4%, right? And
Yeah.
you kind of touched on this too. And kind of similar to the discussion on rules of thumb, don't get entirely caught up on the 4%. Although it is a good baseline to use, understand as well that it's not the only measurement for portfolio withdrawals during your retirement, right? Eric was kind of touching on before what some people do, which is a little bit more of a dynamic strategy of pulling withdrawals out of their portfolio based off of the actual performance of their assets and measuring, what's the highest amount that they can take in a given year, and then maybe what is the lowest amount that they can take as well if they ran into sort of a market downturn. So again, there are different methods for calculating all of these things. I think the biggest thing for me and Eric, though, when we sit down with clients, is that we have to really understand really all of what we had just talked about, which is both their personal and their financial circumstances, to then discuss with them sort of the direction that we're going to go with when it comes to measurement of the withdrawals from their portfolio.
Can I add one other thing here, Eric?
Please.
The portfolio withdrawal rate, we often not often, frequently get the question, how much can I draw out each year and be reasonably comfortable that I'm not going to run out of money, right, throughout my full retirement? And that question is very dependent upon how the underlying investments that you hold, how they're allocated, what sorts of, and how aggressive you are, right? Because I think a lot of times when people get close to retirement, they tend to kind of take the balance in their retirement account and be like, okay, this is the high water mark. Now we're drawing it down, right? In many cases, we are building, in working with our clients, we depend on the underlying investments to provide some return to replace some of the income that's coming out. Now, if you think about it, the higher your expected return or the higher your performance year to year, the more of the principal balance that's being replaced, right? And theoretically, the more you could draw out. Now, that comes with more volatility, right? More up and down in the portfolio. But the withdrawal rate is very dependent upon how you actually invest in retirement, which is something Eric's going to touch on here more in a moment.
Yeah, no, I think that's a really good transition point, which is, okay, now how do we invest in retirement? And these questions that you see on the screen here are, again, very common questions that we hear from people, which is, hey, is my portfolio too risky, or is it not risky enough for retirement? What if the market falls before I retire? Am I properly diversified across different asset classes? So starting with the first question, is my portfolio too risky or not risky enough? I would say the big question that often we have to talk about with clients is, what is their risk tolerance, right? What is their personal comfort level with the ups and downs of investing? It's also kind of known as the sleep at night factor. It reflects somebody's emotional ability to handle the volatility of investment gains and investment losses. And it's important to understand what your risk tolerance is. Than your neighbor next door, it might actually be even different than your own spouse. So having these conversations can be pretty difficult, but it's important to do because it's what, kind of going back to Eric's point before, when it comes to knowing how much you need from your portfolio, you have to have sort of a baseline estimate of what your portfolio is expected to grow by, right? And the other thing that I'll say about risk tolerance as well, whether you have a strong or weak risk tolerance, is that can also differ from your capacity to take on risk, right? So risk tolerance versus risk capacity. Risk capacity is more of your actual financial ability to take on risk, depending on more fundamental factors such as your income, your savings, your time horizon, and your goals. If risk tolerance is emotional, risk capacity is more practical, right? So you may have somebody who feels comfortable with taking on more risk, but they're not necessarily in a financial position to take on that risk, or vice versa.
Yeah, I think another way to think of that is if you have saved, for example, more than you need to cover the desired number or the desired amount of monthly income you want to receive, if you've saved more dollars than you need for that, then if the market goes down significantly, you have more capacity to take that risk because your portfolio is actually more than you needed to begin with. So in the short run, if you're drawing money out while the market is down, you're not impacted as much. Whereas if the market goes down significantly and you say, I'm very uncomfortable with that, it makes me nervous, regardless of whether or not I have the capacity to handle it, that's your risk tolerance. Okay, so that's kind of the way you might think of those two a little bit differently.
Mm-hmm. Yep. The second bullet point here is on sequence of returns risk, which kind of again ties to the second question of, what if the market falls right before I retire, or, maybe right after? And really, really simply, what sequence of returns risk is the danger that you're going to have poor investment results early in retirement that are going to significantly reduce your portfolio at the same time that you're taking distributions from, right? So early losses combined with distributions can impact your portfolio in a negative way. And really, this is most crucial within probably the first, for a lot of people, the first maybe 5 years before retirement, and then maybe even the next 5 to 10 years after retirement. So for example, if you're somebody who has $1 million in your portfolio and you're withdrawing about 4,000 a year from that, if you were to experience a significant market downturn in those first 3 years, that can significantly shrink your balance. And even though afterwards you might have a pretty good return on your portfolio, it's just going to be really, really tough for your accounts to actually catch up. And your portfolio now has less time and less money to rebound. So again, this is a really important factor to keep in mind if you're somebody who is in that time period.
Yeah, just very simple. You're starting from a lower point, right? If the market goes down at the beginning of retirement, let's say it goes down 10% your first year of retirement. If you get a 10% return the next year, you're not actually back to level, right? Because you're starting from a lower level. So it's just the risk that the market goes down right in the beginning of retirement, and it puts you kind of on your back foot as you move into retirement.
The third point is going to be on investment diversification, which, again, just sort of broadly speaking here, being diversified across multiple asset classes is going to help reduce the overall portfolio risk that you have, right? So if we're talking about different asset classes and even more specific from there, you may hear names such as, large cap stocks or small cap stocks, or corporate and treasury bonds. Each of these different assets is going to react differently to certain economic cycles. So losses in one area might affect maybe large caps more than they do small caps. So if you're able to diversify across all of them, you're able to take advantage of growth opportunities, but then also not be reliant on just one specific type of stock or one specific type of asset. And in that same vein as well, it's important to also recognize being diversified not only in US stocks, but also international as well. And all of this sort of goes to show, and really for us, it highlights that a more balanced approach is going to lead to a more consistent outcome and long-term returns that are going to help protect your retirement savings from major downturns that when you're in retirement affect you much more harshly than if you're somebody who is 35 years old, right? So again, these three topics I think are really important to keep in mind and to factor when you have to analyze, okay, how am I going to actually allocate my retirement nest egg now?
And I think in practice, this manifests as clients will come to us and say, especially like new clients, for example, say, hey, I'm getting ready to retire next year. So now that I'm moving into retirement, I better pull everything out of the market and I better be invested very conservatively because I can't afford to lose anything right now because I'm taking money out of my investments, right? Which is logical, right? But the fact of the matter is because you're retiring, doesn't mean that you're taking all of your dollars out in the next 12 months, right? Our hope is that those dollars last for 20, 30 years, maybe even longer. And so in order to think about your account as more than just the number on the statement, it has component parts within it. Some of those things can be invested very, in a very secure short-term way, right? And say, hey, this is what we need for income. But we also need to have those other holdings that are positioned for growth to help replace some of what you are drawing out. And so I think people are often surprised when we talk this through with them and we say, no, we're not going to put this all under your mattress. We need to make sure that your dollars are continuing to work for you as you move through retirement.
Mm-hmm. Mm-hmm. Yeah, and actually the one thing that I'll highlight on that too, Eric, is just when we're talking about just risk in general. I think what's important for people to understand, and we had sort of touched on this before, but to acknowledge when their behavior and emotion is affecting their decision making, right? I would say in financial planning, almost 80% of, you know, the 80% of the actions that are taken are really driven more by how somebody feels about something than the numbers on the spreadsheet, right? And I think what's important for people to remember, and it's really where me and Eric come into this as well, is to give them the information about what the spreadsheet says, right? What the numbers say, but then to also highlight for them, it sounds like this is actually how you feel about it. Take take both of those things and then come to a decision. The decision that they choose might not make the most sense from a number standpoint, right? It actually might not be the best for their portfolio. But if that's what's going to make them sleep at night and that's what's going to make them actually stick to a plan, then that's actually what needs to be done in that case. Moving to a different topic now, but again, similar on intentional investing.
Yeah, so this is another one of the topics that I find really interesting and I think provides a lot of value for folks. So I call it intentional investing. It's really just this idea of positioning your different portions of your investment portfolio for what you intend to spend those dollars on, right? So think of, if we think of, I would say like the three main types of investment assets you might have coming into retirement. I would say pre-tax or tax deferred accounts. So money that you accounts that you've contributed to before tax and they've grown tax deferred. Now, when you draw any money out, it will be taxable, right? So pre-tax assets, Roth assets, which you've already paid taxes on, they are growing tax-free, and you will not have to pay taxes when you take the money out. And then taxable investments, or what we might call non-retirement accounts. So those are kind of the three main areas that we think about. And when we're thinking about taking money out of those accounts, in general, something like a Roth IRA, which is growing tax-free, that is from a 30,000-foot view, that's actually where if we're looking at the different parts of your portfolio, that's the portion that we want to grow the most, right? Because it grows without any tax liability. And if we can get more growth in that account and then be more conservative in your other holdings that are taxable either as they grow or when you draw them out, then we can kind of maximize that end of life legacy number. So as an example, a Roth IRA, you might say, okay, if I want to be an overall moderate investor, right? That's my risk tolerance. That's what I'm comfortable with. And that's what I need in terms of an overall return to have a secure retirement. Great. Let's say that you're targeting a moderate investment portfolio. But if we're looking at your three different sections that you have, right? Your taxable, your tax deferred, and then your Roth, you could say of those three, the Roth should be an aggressive portfolio, right? I'm going to invest that aggressively because I want to get as much growth as I can in that account that does not have any tax liability due on it. I want to maximize that, right? So let's invest that one more aggressively. But remember, I'm a moderate investor. So I can't, if I've invested aggressively in the Roth, then I might need to say, okay, well, with my tax deferred assets, that maybe is where I'm drawing my retirement income from, I want to make sure that those are maybe not moderately invested, but those are conservatively invested, right? Because then they are there and available when I need to take money out for monthly income, for example, but also so that I can balance out how aggressive I am in the Roth IRA, right? So if we were to say the Roth IRA is aggressive and the tax deferred or pre-tax dollars, those are conservative, then when we put it all into a pile, right, you're a moderate investor. That's your risk, the risk that you're taking on. We're just concentrating the growth in that Roth bucket, for example. Okay, so we're looking at it as a whole portfolio but the component parts, we want to be strategic and intentional about what those are being invested for. And in many cases, Roth dollars, number one, because they grow tax-free, but number two, because the IRS never forces an account owner to take dollars out of a Roth IRA in the form of required minimum distributions. Those tend to be, in many cases, the last dollars people spend, if they ever spend them at all. So if they never spend them, they can be legacy dollars for children or other heirs, whoever it might be. But we just want to think about the timeline and the purpose of each of those underlying account types and use that to build up to, like I was saying, we want to get to a moderate level of risk, but the component parts within that, we can be strategic about how aggressive or how conservative each of those three buckets are.
Mhm. Yeah, no, Eric, I think that's a really good point. And to actually just to kind of repeat the point about different allocations depending on different accounts, what people should be thinking about is, okay, if account one is invested, 80-20, as in like 80% in the stock market, 20% not in the stock market. That's what account A is, that's what account B is, account C is this, and account D is that. Knowing what those individual account allocations is important. And then to Eric's point, okay, that's what they are individually. What do you actually, what's the allocation if you combine all of them together, right? What is the global or household allocation, right? And then that is where you can really find, okay, now all of my assets, I actually am more moderate in that, 60% of my whole pile is in stocks, 40% is in bonds and cash, right? So really, really kind of breaking that down and knowing how your accounts are invested is really, really important, and making sure that how it's invested matches actually how you feel about it too.
Yep.
Okay. Well, everyone, thank you so much for your attention. This sort of, marks the end of our prepared conversation for today. So for anyone that has any questions, please feel free to use our Q&A, and we can certainly answer as many of them as we can. I do see one right now, which is great. Thank you so much. This question is, what is the current salary limit for Roth contributions? You can't invest if the salary is too much, correct? Yes. The answer to the back one is yes. You cannot make a direct Roth IRA contribution if you make over a certain amount. And again, what that amount is going to depend, first of all, based on your tax status. So if you're filing single or if you're filing married, it's going to depend on how much it's going to depend on how much income you have. But Eric, do you want to talk a little bit about backdoor Roth IRA contributions? Because I feel like that is possibly where this person is going with it.
Yeah, I think there's a couple of ways we could go here. Starting with the Roth IRA, like you were saying, if you earn more than $165,000 as a single individual, so if your modified adjusted gross income exceeds $165,000, you are not eligible to contribute to a Roth IRA. As filing married, if you earn more than $246,000, then you are not eligible to put dollars in a Roth IRA. However, one thing that people often miss is if you have a 401k, a 403b, a 457, and they offer Roth contributions to that account, you are not limited by your income in terms of being able to make Roth contributions. So Eric mentioned earlier the $23,500 limit for 401k contributions. You could earn as much money as you wanted theoretically and still contribute $23,500 as a Roth 401k contribution. However, a Roth IRA does have the income limits as the question indicated there. Now, even if your income does exceed those two thresholds. There are ways that you can still get dollars into a Roth IRA through, as Eric was just mentioning, what's called a backdoor Roth contribution. It's kind of a little bit of a loophole in the tax code. You can make what's called a non-deductible contribution to a traditional IRA. Remember, a traditional IRA is generally a pre-tax contribution. So you put the contribution in, you can take that amount off your tax return. But if your income is higher, as we've been talking about, you're not eligible to deduct that contribution. So you can put dollars into the IRA, but you don't get a tax benefit, right? You don't get the benefit of reducing your taxable income through a traditional contribution, and you don't get tax-free growth on the Roth side. But by getting the dollars into that non-deductible or into that traditional IRA, you can then convert the dollars, so move them from the traditional to a Roth IRA. And if there's any growth on the dollars, you would have to pay taxes on that. But you can get the dollars into a Roth IRA without making that what you might call front door Roth contribution directly from your bank account right into the Roth.
Yeah. We have another question as well, and Eric, I will pose this to you, and then we can talk about this. This question is: if you retire and the market goes down, looks like this person didn't understand what the real strategy was supposed to be. They're wondering if they should just more quote unquote hold on for the ride, or is it some other strategy?
Great question.
Yeah.
So the important piece about as clients are moving into retirement is they need to be allocated, they need to be invested appropriately, right? So we need to be invested like we are a retiree. So if you're coming into retirement, and again, let's use that moderate investor profile, right? So that's taking into account both your comfort level with the market as well as your ability to take risk, right? We're going to be taking income in the next year or so. So we need to make sure that we're not overly aggressive. And let's say that means you're invested 60% in the stock market and 40% in bonds and cash, right? And then you move into retirement and the market goes down. So that stock portion just nosedives, right? Well, we have 40% in this example of that account that is not subject to that market. It isn't experiencing the stock market downturn, right? Bonds are generally a more a less volatile, more conservative investment vehicle. They also pay interest off of the balance, and that can provide income as well. So we tend to think of our accounts as one number, right? It's $1 million of stocks and bonds. But when the market goes down, maybe the stock portion goes down. That doesn't mean that the bond portion went down, right? That doesn't mean that you're not still getting interest off of those, and you don't have the ability to still get your monthly deposit, either from the interest off of the bond investments that you hold, or maybe even from liquidating some of those holdings and selling them to create income for yourself while you potentially wait for the market to recover. But to be direct about the question, our view as a firm is that yes, you do want to hang on for the ride, right? Because if you look at any research related to this, the idea that you can do anything else when the market goes down and not hurt yourself in the long run is pretty doubtful. And the fact of the matter is, we want to build a retirement plan where you have assets off to the side that are not subject to or impacted by that big market downturn, so that you have something to live off of while we wait for that market to recover.
Yeah.
So that answer, I hope that answers the question.
Yeah. One, Eric, I think that was a good answer, and what I would also add on to that as well, if you're somebody who, if you're in a position where you're looking at your portfolio and you think, okay, I think the market is going to go down from here, or I just can't sleep at night with how I feel about the market, and you're somebody who is more aggressive, right? Let's say maybe you have 90% of your assets in the stock market. That could be an opportunity to trim some of that and then to be more moderate at that point in time, right? It becomes more challenging. It's not something that we would suggest when somebody is at the end of that, when they're actually have gone through the market downturn and everyone's hair is on fire and they're freaking out. Those are the times where people should be pausing and waiting and being controlled. It is before those times that you should be measured and thinking about how much risk can I tolerate and how much am I willing to see my portfolio go down by. Ask yourself that question and make a decision when the market is up, not when the market is down. So, okay. I think that's going to be all the time that we have today. Again, thank you for everyone who was able to throw in some questions. If you weren't able to get any of your questions answered, please feel free to reach out to us, and we will certainly do our best to answer them for you. For those of you who are already clients of Klaas, please feel free to reach out to your current advisor with any comments or questions. And if you're somebody who is new to Klaas, just as a reminder, Klaas Financial does offer a no-cost initial consultation for those looking for a second opinion on their financial situation. Today's webinar is going to be was recorded, and then will actually be uploaded to our website, hopefully within the next 1 to 2 weeks, to give you an opportunity to review. And the last point that I want to make as well is to continue to keep an eye out for additional Klaas U webinars that our team will put out throughout the year. So thank you so much for joining and participating. Eric, do you have any final thoughts or comments for the people?
I have one quick comment, and we had one final question come through that has to do with that initial consultation. So I think that it would be a really quick answer and hopefully helpful for folks. So the question was, what information and/or financial documents should I be getting ready to bring to an initial meeting to maximize getting started with retirement income planning? This is a great question, and I think I'll list some documents that we always ask people to bring along with them. Number one is a paycheck stub. Not that you literally, I know in this day and age, get a paycheck stubs often, but you can access it where it shows, your gross income, your tax withholding, your retirement contributions, and then your net pay. That gives us a ton of information to evaluate income need. A social security statement, so logging into your account at ssa.gov to get an up-to-date social security statement to give us an idea of what your benefit might be on a monthly basis. Statements for any retirement or investment accounts that you have. And then generally just kind of like a summary of your assets and liabilities. So maybe your home, your mortgage, any car loans or other debt that you might have, just kind of a quick summary of what you might say is like your personal balance sheet. Anything else that you'd add to that, Eric?
No, I think all of that was great. Yeah, good question too. So, all right. Well, again, thank you so much for joining. Again, please reach out to us with any questions. But we hope you have a great rest of your night. Take care.
Thanks.